strategist, bullseyeoption.com, to get his take on this. Alan, I know you're not a numbers guy. I know you're more a price, right? Looking for opportunity within situations that are presented there. But let's just talk about the data for a second, because this does kind of, I feel like, come in line with what we've been seeing. For one, pretty strong labor conditions still here in the U.S., but also kind of hitting that sweet spot, I guess, in many ways.
Right. And tomorrow's a big number, obviously. Yeah. But, today is just a continuation. We're in a bull market. There's no question about that. And then we just have to see how we react, after you get these profit-taking pullbacks. So that's what's most important. But the rate cuts are coming. They are coming. I loved your last guest and his optimism with the spin on what lower energy prices cost, will do to the markets. And the fact that you loaded up on gas below $3, I know you were looking for a little arbitrage, but you can only carry so much gas in your car.
Oh, I was loading up, and then you should have seen me siphoning it off, trying to sell it to my neighbor when I got back into Chicago. You know I'm always looking for that arb. Still have the taste in my mouth right now. That's brutal. Hey, but unit labor costs coming in 0.4. They were looking for 0.9. And well below what it was last reading, 4.0. I mean, again, these inflationary figures are showing that the Fed's made progress. Maybe it is time for rate cuts, Alan.
Oh, it is. It's definitely time. And, the markets are telling us that. So there's getting close to a 50% chance that it's going to be half a point. But even if it's only a quarter point to kind of lessen the political outcomes here, there is a 75% chance that one of these two here in September or December are going to be a half a point. So, it's coming. It's coming hard. And if you look out to next year, even look out to January, we're looking to be a point and a quarter below where we are right now. So the cuts are coming. The dollar, had a little bit of a flare up with the markets having some more funny profit taking on Tuesday. But the dollar's looking to make another swing on that 100. And that's going to be another bullish catalyst, obviously.
Maybe that's what we're going to need to get this commodity super cycle that you've been talking about for a while back on track, right? Because while gold has performed well, crude, we were talking about it earlier in the show, grains, for the most part, the metals other than gold, has kind of been lagging a little bit amidst some of these economic concerns.
Right. And it is interesting here, but from a risk reward standpoint, and I trade long-term options, 3 to 6 months out at minimum, you're seeing some great opportunities. You mentioned corn. Corn's coming to harvest season, and I did my little corn crop tour, and everything looks good, obviously, from what I saw in Wisconsin and Indiana. And so now this harvest is behind us, and we'll start looking to see what happens in Brazil and South America and where we go from there. But we're always one crop year away from, some price pop potentials when it comes to the grain markets. We haven't seen beans in the teens in a long time. And, the corn looks like it's bottoming out. So it's risk reward. If you look at the GCI, the commodities basket, we're down here and, we're below the 600 level. We've been between 400 and 800 for many years. 600 has been kind of a pivot, but we're at near the year low for the commodities basket. Like you said, the only exception here recently has been gold, but this can all turn around with this dollar fall.
Alan, talk to me, because some of our other guests have actually talked about some of the opportunities that grains present at these lower levels, and we have seen a bit of a reversal coming off the last couple weeks or last week or so. What about copper, though? It looks like it's starting to roll over here again right now. Take out those August lows. I mean, you're talking levels we haven't seen since the spring of last year.
Yeah, we've got some disappointment, and for every time the markets look like they should make their move, they have every reason to get firmer. Sometimes they don't, and we've talked about this before, that sometimes the markets have delayed reaction. The easy play people thought was to get long crude oil when all this started with Ukraine and the Middle East, and obviously that hasn't developed. And people are obviously focused on copper, but with the exception of, I guess, Japan's made a big storm back. China has firmed up a little bit. You've actually seen Europe make new all-time highs in their stock indexes. So it's this global weakness thing is, I think, a little bit overblown.
Yeah.
Again, we see profit taking, but the markets rebound each and every time. Let's look at what happened on Tuesday, and I still don't have a real good reason. I know I don't trade reasons. I trade charts. I don't have a real good reason that the market pulled back 2% on Tuesday, just except because.
Yeah.
Because is really the reason, and it did. And we've been between 5,500 and 5,650 now for 3 weeks in the S&P, going completely sideways, a complete flag here. So a breakout of this flag to the upside, which is a continuation of a bull market, sends us to 5,800. But a break below 5,500 could give us some real clues on what's happening, and see how the markets respond if that happens.
Alan, I might have been blowing things out of proportion a little bit as well. I said take out that August low back to spring of last year. Yes, we're back to spring of last year levels. It would actually just be the spring of this year. I just wanted to correct myself. But I like that. And real quick, the data tomorrow, will it give us reason to tip the scales one way or the other? Will it give us reason to kind of make a move one way or the other, or finalize things in terms of the Fed, or is it just going to further speculation?
Well, again, I'm the bull market genius guy. So I'm going to tell you that, this number is going to give us what we want. And what we want are rate cuts. And rate cuts are coming.
Okay.
And this number is going to be soft enough to give us that.
Okay.
And again, still 100,000 or whatever, 160,000 in growth. We would have been happy with that for many, 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 many years. We've had such outstanding numbers. You know what? They're not bad. They're just less outstanding. That's all it is.
Yeah.
So it's given the policymakers some little pause that they needed. They've done what they've wanted. They've landed this plane, and you're getting $2.99 gas. I don't want to hear any complaints from you for a little while, because that's got to make you happy. Just put that in your back pocket, carry that around with you, that receipt, and remind yourself that inflation has been tamed.
Yeah, the data hasn't been outstanding. It has been good, though, to your point, and that's
it's not just data; it's facts. You paid $2.99, Ben, and we live in Chicago.
That's a glass half full approach. That's for sure, Dad, that you always bring to the table, Alan. We appreciate that, and in many ways, it's not necessarily that the numbers have been bad. It's just that they haven't been as good, I guess. Right. Different way of stating your point there.
They've been less outstanding. Let's go with that. Less outstanding.
I think the takeaway here is that rate cuts are to come. Alan, appreciate you joining us. We'll see how market reacts to that, right? That's what really matters. Chief Market Strategist at BullseyeOption.com. Alan Scissorhands there, I think that was.